In the middle of 2025, something quietly changed inside one of the most respected companies in the automotive world. It wasn't a flashy press release or a dramatic public announcement. Instead, it came in the form of an internal message written by Porsche's CEO, Oliver Blume, and sent directly to employees. Inside that message was a single sentence that carried more weight than most earnings reports ever could. Our business model no longer works in its current form. For a company like Porsche, those words were extraordinary. This was not a struggling startup or a volatile tech firm. This was Porsche, a brand built on discipline, engineering pride, and decades of financial consistency. For most of its modern history, Porsche was considered one of the safest bets in the global auto industry. It had survived oil crises, financial crashes, and dramatic shifts in consumer taste. And yet, here it was, openly acknowledging that the formula it relied on for decades was no longer enough. To understand why this moment mattered so much, you have to understand what Porsche represented. Porsche was never just another car company. It was a symbol of control and intention. Every model felt deliberate. From the outside, Porsche appeared almost immune to chaos. While other automakers chased volume, discounts, or rapid reinvention, Porsche stayed focused on a narrow but profitable path. It built cars that were fast, expensive, and emotionally powerful. And people paid for that feeling, year after year. The company didn't need to shout. Its reputation spoke for itself. That's why hearing doubt from inside Porsche felt unsettling, not just for investors, but for the entire industry. The numbers that followed only deepened the shock. In the first 9 months of 2025, Porsche's operating profit collapsed by roughly 99%, falling from over 4 billion euros to around 40 million. In simple terms, the company went from extraordinary profitability to barely staying above water. At the same time, demand softened in key markets, costs exploded, and the transition to electric vehicles became far more complex than executives had planned for. These pressures didn't arrive one at a time. They hit all at once. What made the situation so remarkable wasn't just the scale of the decline, but who it was happening to. If a company as carefully managed as Porsche could stumble this badly, it raised a far bigger question. What had changed in the world, and why did Porsche's once perfect business model suddenly stop working? For most of its life, Porsche was a company you could rely on. Even when the wider auto industry struggled, Porsche usually found a way to remain stable. Sales rose steadily, margins stayed healthy, and the brand's image barely cracked under pressure. That stability wasn't accidental. It was the result of choices made decades earlier, starting with the company's earliest cars. When the Porsche 356 debuted in 1948, it immediately signaled what the brand cared about. The design was light, clean, and purposeful. There was nothing excessive about it. That philosophy carried forward and slowly shaped an identity that became almost impossible to copy. Nothing embodied that identity more than the Porsche 911. Over the decades, its shape barely changed, yet it never felt outdated. The low nose, round headlights, and smooth rear curve became instantly recognizable across generations. Even people who had never driven a Porsche could identify a 911 from a distance. That visual consistency helped create emotional trust. Buyers felt like they knew what they were getting. Porsche didn't need to reinvent itself every few years. Instead, it refined what already worked. That refinement became part of the brand's promise. But sports cars alone weren't enough to build the business Porsche has today. The real transformation came in the early 2000s with the introduction of the Cayenne SUV. At the time, purists were outraged. A Porsche SUV felt like heresy, but commercially it was a masterstroke. The Cayenne and later the Macan brought Porsche into everyday life. These models expanded the customer base, increased production volume, and generated the cash needed to fund sports car development. At the same time, racing success reinforced the brand's credibility. With tens of thousands of motorsport victories over the decades, Porsche's performance reputation felt earned, not marketed. Ownership experience mattered too. Porsche dealerships consistently ranked high in customer satisfaction, and buyer loyalty remained strong, particularly in the United States. All of these elements worked together to create a rare balance. Porsche felt exclusive, but not distant. Premium, but still familiar. It was a system that seemed almost unbreakable. Behind the scenes, Porsche's financial discipline was just as important as its design language. The company maintained tight control over production, relying heavily on vertical integration to manage quality and cost. This approach allowed Porsche to keep margins strong, even while producing far fewer vehicles than mass-market brands. On average, Porsche earned around €18,000 in profit per car. That figure didn't match Ferrari's extreme margins, but within the broader luxury segment, it stood out. Porsche had found a sweet spot between volume and exclusivity, and for years, it worked exceptionally well. Pricing reinforced that position. A new Porsche 911 started well above $100,000, with higher trims easily crossing $200,000. Even older models held their value remarkably well, often appreciating over time. This created a perception of safety among buyers. A Porsche wasn't just a purchase, it was an asset, a statement, and an experience rolled into one. Few brands managed to combine emotional appeal with financial logic so effectively. From the outside, Porsche looked almost immune to the volatility that plagued other automakers. That's what makes the collapse in 2025 so difficult to reconcile. This wasn't a company gambling recklessly or expanding too fast. Porsche did what it had always done. It invested carefully, protected its brand, and planned for the future. Yet profits still fell off a cliff. Revenue declined. Deliveries dropped. The formula that once delivered consistency suddenly produced uncertainty. This wasn't a slow decline or a single bad decision. It was the result of multiple forces converging at once. Economic pressure, technological shifts, and changing consumer priorities were all pushing in the same direction. And for the first time in decades, Porsche found itself reacting rather than leading. The question now wasn't just what went wrong, but whether the old rules of the luxury automotive world still applied at all. By early 2025, the cracks in Porsche's once solid foundation were becoming harder to ignore. The first major warning sign came from China, a market that had quietly grown into one of Porsche's most important pillars. For years, Chinese buyers embraced the brand as a symbol of success and global prestige. Porsche showrooms in cities like Shanghai and Beijing were busy, and demand often outpaced supply. But then, almost suddenly, the momentum shifted. Deliveries in China dropped by more than 40% compared to the previous year. That kind of decline doesn't happen without deeper forces at play. At first glance, it could be blamed on a broader slowdown in luxury spending. China's economy was under pressure, and discretionary purchases were naturally affected. But that explanation only covered part of the story. The bigger change was competitive, and it caught many traditional automakers off guard. Chinese car manufacturers were no longer just producing affordable basic vehicles. They were building advanced electric cars with strong performance, impressive range, and highly refined software experiences. Brands like Zeekr, NIO, and even Xiaomi entered the conversation with vehicles that felt modern, intelligent, and surprisingly polished. These cars didn't rely on decades of heritage. Instead, they focused on what mattered most to modern buyers: seamless digital interfaces, frequent software updates, and value for money. In that environment, brand legacy alone stopped being enough. For Chinese consumers, the question began to change. Instead of asking which badge carried the most prestige, buyers started asking which car offered the smartest technology and the best daily experience. A vehicle that felt intuitive, calm, and digitally advanced suddenly mattered more than one with a long racing history. Porsche, a brand built around mechanical excellence and emotional driving feel, found itself competing on unfamiliar ground. The shift wasn't just uncomfortable, it was structural. Porsche wasn't losing relevance because its cars became bad. It was losing ground because the definition of a great luxury car was evolving faster than expected. And China was showing the world what that new definition might look like. At the same time, Porsche was facing internal pressure from its own electric transition. The company entered the electric vehicle market with confidence, led by the Taycan. At launch, the Taycan was widely praised. It delivered strong performance, unmistakable Porsche styling, and a driving experience that felt true to the brand's DNA. Early demand was strong, and it appeared that Porsche had successfully carried its identity into the electric era. But momentum didn't last. By 2024, global Taycan deliveries dropped sharply, falling by nearly half. Interest cooled. Not because the car failed, but because the EV market itself became unpredictable. Porsche had once set an ambitious target: 80% of its sales would be electric by 2030. By 2025, that goal was quietly scaled back. CEO Oliver Bloom openly acknowledged that the timeline was no longer realistic. The problem wasn't a lack of engineering skill. It was cost, complexity, and uncertainty. Electric vehicles demanded enormous upfront investment. Factories had to be reworked. Supply chains had to be redesigned. Battery production required long-term commitments with volatile pricing. Porsche spent billions upgrading facilities and expanding its manufacturing capabilities to support multiple powertrains at once. These investments made sense in theory, but in practice, they placed enormous strain on the balance sheet. The challenge was timing. Porsche was spending heavily just as demand became harder to predict. Unlike traditional combustion engines, where costs and pricing were well understood, EV economics were still shifting. Battery prices fluctuated. Software development required ongoing expense. Regulatory pressure added further complexity. And unlike mass market brands, Porsche couldn't rely on scale alone to absorb these costs. Every decision carried higher risk. The company found itself caught between two worlds, too premium to compete on price, but not insulated enough to ignore market volatility. What once felt like a controlled transition now felt like a balancing act with very little margin for error. Beyond product strategy, the broader economic environment added another layer of difficulty. Trade tensions and tariff pressure began to bite at exactly the wrong time. Proposed import tariffs in key markets, including the United States, threatened to push costs even higher. Porsche estimated that these measures alone could add hundreds of millions in additional expense. When combined with ongoing investments in electrification and factory upgrades, the financial picture became increasingly tight. In total, Porsche projected investments of over €3 billion in 2025. Even with careful planning, the company was only expecting a slim positive margin once all external pressures were accounted for. This is where the story shifts from a single company's struggle to something much larger. Porsche wasn't alone. Nearly every high-end automaker was facing similar challenges. Ferrari, Bentley, Mercedes, AMG, BMW, all of them were pouring vast resources into electric platforms while trying to preserve brand identity. But Porsche's situation stood out because of its reputation. This was a company known for discipline, precision, and caution. When Porsche felt pressure, it suggested that the entire luxury performance segment was under strain. The deeper issue was balance. Porsche needed strong sales to fund innovation, but expanding too far risked diluting exclusivity. For decades, the company had walked that line carefully. SUVs expanded volume. Sports cars preserved identity. But the electric era tightened that balance even further. High-performance EVs were expensive to build, and pricing them correctly became a serious challenge. Price them too high, and demand disappears. Price them too low, and margins collapse. In this environment, even small miscalculations carried large consequences. Porsche wasn't failing because it lost control. It was struggling because the rules of the game had changed, and the old playbook no longer guaranteed success. As all these pressures converged, Porsche found itself in a position it had rarely experienced before: uncertainty about scale. For decades, growth had been the solution. When sports cars alone were not enough, Porsche introduced SUVs. When purists complained, profits proved the strategy right. Expansion funded innovation, and innovation reinforced the brand. But by 2025, that logic began to break down. The luxury SUV market was no longer a wide-open opportunity. Nearly every premium automaker had multiple entries, and competition intensified. What once felt like a clever diversification strategy now felt crowded and defensive. At the same time, the shift to electric vehicles removed many of the traditional advantages Porsche relied on. In the combustion era, engine tuning, mechanical feel, and racing heritage created clear separation. In the electric world, many of those differences became harder for consumers to perceive. Instant torque and smooth acceleration were no longer unique. Software, user interface, and battery efficiency started to matter just as much, if not more. This created a difficult tension for Porsche. To remain competitive, it needed to invest heavily in areas that were not historically central to its identity. Yet doing so risked turning the brand into something more generic. This tension showed up most clearly in pricing. High-performance electric cars are expensive to build. Batteries, cooling systems, advanced electronics, and software development all add cost. Porsche could not simply lower prices to chase volume without damaging margins and brand perception. But keeping prices high limited demand in a market where consumers were becoming more value-conscious. The balance between exclusivity and accessibility, already delicate, became even harder to maintain. Porsche wasn't just adjusting its lineup. It was being forced to rethink what luxury performance meant in a rapidly changing world. What makes Porsche's situation especially significant is what it signals beyond the company itself. Porsche has long been considered one of the most disciplined automakers in the world. Its operations were tight. Its planning was conservative. Its financial performance was admired even by competitors. When a company like Porsche publicly acknowledges that its business model no longer works, it sends a message far beyond its own balance sheet. It suggests that heritage alone is no longer a safety net. Brand power once built over generations is no longer guaranteed protection against rapid technological change. The luxury automotive sector is entering a phase where the cost of staying competitive is rising faster than demand can reliably support. Research budgets are growing. Regulations are tightening. Consumers are becoming more selective. At the same time, new players, particularly from China, are entering the market with fewer legacy constraints and a strong focus on software and integration. These companies are comfortable operating on thinner margins while they scale, something traditional luxury brands struggle to do. The competitive landscape is no longer defined by a handful of European manufacturers setting the pace. It is global, dynamic, and increasingly unforgiving. In this context, Porsche's challenges look less like a failure and more like an early warning. The company is confronting problems that others will soon face, if they are not already. The old assumptions that customers will always pay a premium for history, that gradual evolution is enough, that brand loyalty is stable, are being tested. Porsche's response to this moment may help define how the entire luxury performance segment adapts. Whether it succeeds or struggles, its choices will be closely watched, not just by fans, but by competitors and investors around the world. Looking ahead, opinions on Porsche's future are divided. Some observers believe the brand is drifting away from the qualities that made it special. They argue that chasing electrification and broader appeal risks diluting the emotional connection Porsche built over decades. From this perspective, the road back to strong profitability may be long and difficult, especially if electric performance fails to resonate in the same way as traditional sports cars. Under this view, Porsche's struggles are not just cyclical but structural. Others see the situation very differently. They view this period as a necessary recalibration rather than a decline. Porsche has reinvented itself